Welcome back to Sip and Talk.
Hello and welcome.
Welcome, Sip and Talkers. So I have a bit of a problem.
Oh, yeah.
Yeah. I opened up my app this morning, and honestly, the chart looks scarier than a horror movie.
I know that feeling. I really do. Last week it was all, the grand age of sail for AI. We were charting a course to the moon.
Totally.
And this week it's suddenly the AI Volatility Week special. The whole market just took a nosedive. I thought someone had pulled the plug on the whole pool party.
That is the perfect analogy. And speaking of the pool, it brings up that classic Buffett quote, right? Only when the tide goes out do you discover who's been swimming naked.
And the tide is going out fast.
It's halfway to Bermuda. So that's what we have to figure out today. Is this huge systemic plunge a chance to, buy the dip? Or is this the fire alarm for the great escape?
That's the billion-dollar question. And what's so frustrating for everyone, I think, is that the industry itself is still booming.
Right, the demand is there.
It's physically real. You can't get enough chips. Data centers are being built everywhere. And yet all of a sudden the analysts are out there waving these super dry terms around.
Oh, the scary words.
The scary words,
Yeah.
Depreciation, cost of capital, valuation, interest rates. And that's what's making everyone's face turned the exact shade of a Zoom background when the Wi-Fi dies.
Okay, I'm officially pale now, and I am ready to get into it.
Yeah.
So today, we're going to unpack this from every angle.
Yeah.
We're looking at the big macro picture, the crazy spending habits of the tech giants, the CapEx, those super short hardware cycles.
They're terrifying.
And that phrase that everyone keeps repeating, that AI won't bubble, but the stock price will.
Yeah.
What does that actually mean?
Exactly. So for the next 30 minutes or so, we're going to try and give you the tools to analyze this moment. We're going to figure out if this green face moment is a real entry point, or if it's, the prelude to something much bigger.
All right. Welcome to today's Sip and Talk. Let's
Yeah.
take a deep breath and jump in.
Oh.
Okay, so to really understand this volatility, we have to start with the data. The cold, hard numbers.
Right. Because that's where you see the central tension. It's this collision of massive potential with, very early stage reality.
So there's good news and bad news. Let's start with the good.
The Federal Reserve Bank of Richmond, they put out some survey data recently, and it shows some pretty significant movement.
Okay.
The percentage of businesses that said they actually used AI in the last 2 weeks.
Okay, so not just planning to, but actually using it.
Right, actively using it. That number jumped from just 3.7% back in 2023
Wow, that's tiny.
to nearly 10% now. So that's almost a threefold increase in 2 years. That's real.
That is real growth. And what about future plans?
Even more ambitious. The number of businesses expecting to use AI in the next 6 months, that jumped from about 6% to over 14%. The signal is clear. Corporations are all in.
But that's where the problem starts, isn't it? That gap between expectation and reality.
It's a huge gap. I mean, 10% usage is great progress, but it's nowhere near saturation.
No.
But the stock prices we saw 2 weeks ago, they were pricing in universal adoption happening tomorrow.
Total world domination immediately.
And when a reality check like that 10% figure hits, investors suddenly realize the ramp up is going to be slower than the hype, and boom, volatility.
And that leads right into the valuation problem.
Yeah.
This is like textbook bubble warning sign territory.
It really is. Reuters did a piece on this, highlighting how companies are planning to invest trillions of dollars. I mean, the CapEx plans are just astronomical.
Unprecedented.
But the big question is, does the jump in stock value actually line up with the eventual return on that investment, the actual ROI?
And a lot of analysts are saying, probably not.
Well, you look at the Goldman Sachs report and they just lay it out. Valuations for a lot of these AI-adjacent companies are based almost entirely on future growth.
Not current profit.
Not current revenue, not current profit. They're based on perfect execution for the next 5, sometimes 10 years.
So just to connect the dots for everyone, what happens when a stock is priced that way? When it's all based on the future?
You get extreme instability. It's what we're seeing right now.
Right.
In the dot-com era, it was all about eyeballs and potential. Today, yeah, the big companies have real profits, but the AI growth part of their stock price is still pure speculation.
So any little thing.
Any piece of bad news, a competitor, a missed target, higher interest rates, it forces the market to reset that 10-year fantasy back to today's reality.
Yeah.
And the higher the fantasy, the harder the crash.
And this whole thing is just magnified by the insane market concentration. It's not one or two frothy stocks. It's the whole market.
This is the systemic risk part that has regulators spooked.
Yeah, that Schroeder's data point is just chilling.
It is. The top 8 U.S. tech companies, the AI core, they make up something like 39% of the entire U.S. stock market.
Almost 40%.
Think about that. If that highly concentrated group of 8 stocks falls together, it's not an isolated event.
No, it drags everything down with it.
Everything. Bank regulators are worried about contagion. A crash in those names could impact pensions, mutual funds, even the stability of the banking system. It goes from a tech problem to a market crisis really, really fast.
It totally changes the risk calculation for the average investor. A dip in a chip maker isn't just about chips anymore.
It's about the entire S&P 500. And let's add one more data point the bears are loving right now.
Okay, lay it on me.
The failure rate of corporate AI projects.
Oh, I've heard about this. It's bad, isn't it?
It's staggering. Market data suggests that something like 95% of corporate AI pilot projects
95.
never reach mass production. They never generate real economic benefits. They just die.
So for every 100 projects that companies spend billions of dollars on, all that CapEx for chips and engineers, 95 of them are just sunk costs.
It's just the bridge from, hey, we're spending trillions to, hey, we're making trillions is incredibly shaky. That 95% failure rate is what bears point to and say, see, the valuations are based on a fantasy.
And the market is just now starting to price in that failure rate.
Violently, yes.
Okay, so the foundation is just definitely shaky. High hopes, early days, massive concentration, and wow, and 95% pilot failure rate.
Not a great combination.
No. So let's get into the big debate. Is this a healthy, necessary correction, or is this the start of the big one, the bubble bursting? Let's start with the bears. Give me the scariest version.
Okay, the bear case is that this is classic overheating. Too much money chasing too few proven ideas, all fueled by herd mentality. The money is just flowing into AI concepts without any real thought about actual returns.
And we're hearing a lot of scary historical comparisons being thrown around.
A lot. You have the CEO of Goldman Sachs warning about a major correction coming, and when someone like Ray Dalio comes out and just flatly calls this .com 2.0, you have to listen.
Yeah, you do.
And those comparisons are backed up by the sheer size of it all. Deutsche Bank put out research suggesting that when you measure the total market cap tied to AI, this bubble is potentially 17 times larger than the .com bubble was at its peak.
17 times. That's almost hard to comprehend.
It is, which leads to that prediction that's been making the rounds, the one that makes everyone's heart stop.
The Michael Burry one.
The Michael Burry and others in that camp. They're predicting a potential $40 trillion evaporation of market cap between 2026 and 2028.
How does an investor even process a number like 40 trillion? What does that even mean?
It's the theoretical worst-case scenario. It's the total value that could be wiped out across everything that's been inflated by AI hype, not just the big tech names, but all the software companies, the startups, the infrastructure plays, everything.
It's the total systemic damage if faith is completely lost.
Exactly. It's what happens when that 39% concentration risk goes terribly wrong.
And there's a new twist to the bear case this time, something that wasn't really a factor in 2000. Cost deflation.
This is a really interesting threat. We just saw this company, DeepSeek, emerge with a really high-performance AI model.
Right.
And it was trained for only $6 million.
$6 million. That's it. I thought these things cost billions.
The big ones do, and that's the whole business model for the giants. Their competitive advantage is that only they can afford the massive CapEx.
Their moat is built on money.
Right. But if a competitor can create a high-quality, open-source model for less than the price of a mansion in Beverly Hills,
It completely shatters that moat.
it challenges the entire high-cost ecosystem. The fear is that the cost to produce great AI plummets, which means the services built on it become cheaper, and the massive valuations of the current leaders just can't be justified anymore. That DeepSeek news was a big win for the bears.
Okay. Let's pull back from the ledge. Let's flip the script. The bulls are saying this is just a healthy shakedown, a buying opportunity. What's their argument?
The strongest bull argument is that this is fundamentally different from the 1990s.
How so?
Invesco makes this point really well. The companies driving the revolution today, Microsoft, Amazon, NVIDIA, they have massive established profits. They have real cash flow. The .com era was built on companies that were losing money hand over fist.
They were selling dreams. These companies are selling actual products and services.
And the demand for that underlying infrastructure, the chips, the data centers, the power, it's physically necessary for the modern economy to function. We're not just funding ideas, we are building the digital equivalent of railways and power grids. That spending is real.
That's a great point. And they have the cash to do it, right? It's not all built on debt.
Not at all. U.S. corporate cash reserves are incredibly high. High enough to fund this build-out until at least 2030, even if profits take a temporary hit. That financial cushion makes a sudden debt-fueled collapse much less likely.
And then you have the long-term view from the visionaries themselves, people like Bill Gates or Sam Altman.
Right. And they don't even deny that there's a bubble or a fever, as they call it. They fully acknowledge the mania.
But they see it differently.
They see it as a necessary investment.
What does that mean?
It means you can't build a new foundational technology for society, a general purpose technology like AI, without massive, messy, upfront, risky investment. They're not looking at the quarterly stock price. They're looking at the next 20 years. The bubble is just the price society pays to build the future fast.
Okay, so philosophically they're fine with it, but what about the actual drop we just saw? Like 4 to 10% on some of these big names. The bulls aren't panicking. Why?
They see it as seasonal, just healthy profit-taking after a massive run-up, or a simple cyclical correction.
A correction, not an ending.
Exactly. The thinking is that the technology is too powerful, and the corporate need for efficiency is too urgent for a total collapse. This is just the market shaking out the tourists and finding a more reasonable price for the long-term journey.
All right, let's get into the weeds a bit. Let's talk about the specific balance sheet mechanics that really started this panic.
This is where it gets technical, but it's so important. We have to talk about depreciation.
The accelerated depreciation killer.
That's what some are calling it. And it's Michael Burry's big focus right now. The core idea is simple. AI hardware becomes obsolete way, way faster than traditional IT gear.
Okay, so walk us through that.
Yeah.
Why does an H100 GPU die faster than a regular server? It's not physically breaking down, right?
No, it's not a physical failure. It's economic obsolescence. A standard server might be useful for 4, 5, maybe even 6 years.
Right.
But a specialized AI accelerator, its truly competitive economic life might only be 2 to 3 years.
Wow. Why so short?
It's the pace of innovation, especially in things like high bandwidth memory, HBM, and the interconnects that link the GPUs together.
So the next generation is just so much better that the old one becomes a liability.
Precisely. The new B200 chip is way faster and more efficient than the H100. If your competitor has a data center full of B200s, your H100s suddenly can't compete on cost or performance. You lose the arms race if you keep the old gear. It becomes economically irrational not to upgrade.
And this is where Barry's big warning comes in, the accounting trick.
Yes. The fear is that these giants might be, let's say, stretching the useful life of these assets on their books.
So they're telling investors a GPU is good for 6 years, when in reality it's only useful for 3.
Potentially. And if you do that, you get to understate your depreciation expense by billions of dollars each quarter, which makes your profits look way bigger than they actually are.
That feels borderline fraudulent.
The accounting consequences are enormous. Burry projected this could lead to a $176 billion overstatement of profits across the big players by 2028.
Has anyone actually admitted to this?
Well, Amazon Web Services recently announced they were shortening the useful life of some AI servers from 6 years to 5. And that one change is estimated to reduce their operating profit by $700 million.
Just from 1 year.
Right. It's a direct hit to the balance sheet. So the bottom line here is buying new gear every couple of years isn't optional for these companies. It is a mandatory, recurring, and massive expense.
And the real danger is when the cost of that new gear outpaces the revenue they're actually making from the AI services.
That's the treadmill. That's the fear that's hitting the market.
Which brings us to the AI military arms race, the CapEx dilemma.
It's a perfect example of the prisoner's dilemma from game theory.
How so?
Every one of the tech giants, Microsoft, Google, Meta, Amazon, they know that if they stop spending for even a single quarter, they risk falling behind permanently.
They lose their leadership position.
Instantly. So they're all forced to keep spending at this insane pace, even if it's inefficient, just to keep up with each other.
And the numbers are just staggering. What are we looking at for 2025?
The 4 giants are projected to spend somewhere between $320 and $380 billion
AI investment globally.
It is. But we have to be smart about this and look at the quality of that spending. It's not all the same.
Okay, break that down.
You have the leaders, mainly Microsoft, with their OpenAI partnership. They are turning that CapEx into immediate revenue.
Through Azure Cloud Services, Copilot subscriptions.
Exactly. They have a clear, high ROI loop. They spend $1 on a server. They can rent it out for $2 tomorrow.
And then you have the others, the chasers, like Meta.
Exactly. Meta is spending defensively. They're pouring billions in, but it's for long-term ecosystem survival. The short-term ROI is much, much lower. It's not clear how that spending translates directly to profit today.
So the market is starting to separate the spenders from the earners.
That's the key shift. The question used to be, how much are you spending? That was the hype. Now the question is, how much are you making? That's the ROI check. And that's what's causing all this pain.
Okay, so that rigorous ROI check leads us perfectly into that mantra everyone's repeating. AI won't bubble, but the stock price will. Let's break that down.
Understanding this is probably the most important thing for an investor right now. It separates the technology from the speculation.
So let's start with the first half. Why won't AI, the technology, bubble?
Because it's what economists call a general purpose technology, a GPT.
Like electricity or the internet.
Exactly. It's a fundamental, irreversible shift in how the economy works. It creates real productivity, real value, new industries. Even if a specific AI company fails, the underlying utility of the technology itself is permanent and necessary. That value is real.
It's the foundation. But the stock price, that's a different story.
A completely different story. The stock price isn't driven by reality. It's driven by expectation and emotion.
And greed and fear.
And greed and fear. The market tries to take 10 years of perfect future growth and price it all in today. When money is cheap and everyone's optimistic, that price gets completely detached from reality.
And when the mood sours, like it has this week,
the press just violently reconnects with the present. So the practical takeaway here is pretty clear.
The safest bets have real cash flow. The riskiest are just pure concepts.
100%. The danger is in the AI concept company with no revenue, whose stock price is pure hope. The big established players, the chip makers, the cloud providers, they're safer. Their stock price might be inflated, but the underlying business actually makes money today. There's a floor.
Now let's connect all this to the elephant in the room. The macro environment. High interest rates.
The ultimate party pooper for growth stocks.
Right. So we have the Fed holding rates at, 5.25 to 5.5%?
Which is the highest in decades.
Yeah.
And you have to understand, mathematically, high interest rates are the single biggest enemy of growth stock valuations.
Explain that. If a company is growing at 30% a year, why does a 5% interest rate hurt its stock so much?
It's all about the discount rate. It's like financial gravity.
Okay.
A high interest rate increases the rate you use to calculate the value of future profits in today's dollars. And since these AI stocks are priced almost entirely on profits they might make in 2030 or 2035...
You discount those future profits more heavily.
Way more heavily. That $10 million profit they might make in 10 years isn't worth as much today when you can get a guaranteed 5% from a government bond. It forces a valuation reset. Yeah. It's just math.
So what we're seeing is the market finally doing its homework and applying that high-rate math.
It's a forced reality check. But, and this is important, there's a counterforce that's preventing a total collapse.
And that is?
Corporate demand. Because of inflation and high costs, companies are desperate for efficiency gains. They need AI to cut costs and boost productivity just to survive.
So even as the stock valuations get hit by interest rates, the actual demand for the AI service remains strong. It creates a floor under the market.
Exactly. So the best way to see this correction is as a slow, healthy deflation. It's not the end of the AI revolution. It's the market repricing that revolution for a world where money is no longer free.
Okay, we've gone through the risks, the data, the macro picture. Let's get practical. This is the survival guide. Assuming you're a long-term believer, how do you navigate this chaos and live to see the next all-time high?
You have to adopt a very specific, very disciplined mindset. We call it the survival math.
All right, I'm ready. Give me the formula for survival.
Survival equals cash flow times conviction.
Okay, unpack that.
You need deep conviction in the long-term thesis. You need a long time horizon, like a decade plus, to ride out the cycles. And you need enough personal cash flow and reserve so you're never forced to sell at the bottom.
And then the formula for disaster, the one we need to avoid.
That one's even simpler. Death equals leverage times volatility times emotion. If you use borrowed money leverage in a market that swings wildly, volatility, your own human emotions will guarantee you sell at the worst possible moment every time.
The biggest lesson from 1999 and even 2022 is that leveraged investors get wiped out. They don't get to participate in the recovery.
They're gone. A 50% drop in your stocks means a 100% loss if you're leveraged 2-to-1. You have to survive. Which leads to the next rule, disciplined buying.
Right. If we know we can't time the bottom, how do we get in without going all in at the top?
You use a laddered approach. You phase in.
Meaning?
Don't invest your whole intended amount at once. Maybe start with a 30% position now. If the stock you like drops another 20% from here, you add another 20% of your capital. If it somehow drops 40%,
you add the rest. It lowers your average cost.
It significantly lowers your cost basis, and more importantly, it takes the emotion out of trying to be a hero and catch the absolute bottom, which is impossible.
This also ties into the next point. Cash is not trash. Cash is a weapon.
In this environment, cash is your superpower. It should be seen as an active position in your portfolio, keeping 30 to 50% in cash, specifically to deploy on days of extreme panic.
To buy blood.
To buy blood. When a great company drops 30% in a week because of macro fear, that's when you use the cash you set aside for exactly that moment.
And finally, let's talk about what to actually buy. The quality screen has to be ruthless right now.
Absolutely brutal. You can't just buy anything with AI in its name anymore.
Those days are over.
Over. You have to focus on companies with deep competitive moats, strong current cash flow, and a proven way to actually make money from all their CapEx spending.
So the cloud giants, the chip leaders.
Right. Avoid the purely conceptual, high-flying startups with no profits. They are extremely vulnerable to high interest rates. You want the companies where spending $1 on CapEx leads directly to customer lock-in and more revenue.
And the final piece of this is the psychological test, the gut check.
This is the most important part. You have to look at history and accept that a massive drawdown is normal in these huge technological shifts.
Like Amazon in the dot-com bust. It fell, what, over 90%?
Over 90%. From peak to trough. The people who made fortunes were the ones who had the conviction and the financial stability to hold on or even buy more.
So the question you have to ask yourself before you click buy today is...
The question is, if this stock drops 70% from where I buy it, am I willing and able to wait 10 years for it to recover?
And if the answer is no...
then you are either investing too much money, you're using leverage, or you're simply in the wrong asset class for your risk tolerance. This isn't a short-term trade. It's a decade-long conviction bet.
Well, that was an absolutely essential breakdown of what's happening. Let's try to summarize the core idea for everyone one last time. The technology, AI itself, is real. It's here to stay.
It's a general-purpose technology. Its long-term value isn't really in question, but the stock valuations, that's a different story. It's been driven by hype and concentration, and it desperately needed a reality check.
Which is what it's getting, courtesy of high interest rates and the fear of depreciation.
Exactly. So this is a moment for discipline, for quality screening, for risk management, and for patience.
Right. The test for an investor right now isn't about being a genius who can predict the bottom. It's about having the financial and emotional strength to survive the turbulence.
History strongly suggests the next all-time high will be higher than the last one, but you have to still be in the game to see it.
That's the key.
Let me just leave you with one last thought to chew on. If we all agree that AI is the future, that it's the next great economic platform,
which I think most of us do,
then maybe the volatility we're seeing right now isn't a bug, it's a feature. It's the price of admission you have to pay to get a seat at a generational shift. The question isn't if the price will be higher in a decade, but whether your personal setup, your lack of debt, your cash, your psychology can handle the 50 or 70% storm you have to sail through to get there.
A brilliant way to frame it. Now, as always, our crucial reminder, we are not financial advisors. This discussion is for informational and entertainment purposes only. Please do your own research before making any investment decisions.
And please, if you found this helpful, subscribe and follow Sip&Talk wherever you get your audio fix.
And while you have your phone out, give a shout out to our good friend and check out his YouTube channel, Mickytolife. We've heard his infamous doomsday portfolio is actually soaring right now, which just proves what a strange and unpredictable world the market really is.
It truly is.
Thanks for tuning in to this special edition of Sip&Talk.
We'll see you in the next one.